Good evening. Welcome back, or if this is your first time here, welcome. Tonight we're going to explore something that changed the world economy in ways still felt today. We'll discover the 2008 financial crisis slowly and patiently, moving through the optimistic years of rising home prices, through complex financial instruments that few understood, to the quiet unravelling that began in suburban neighbourhoods and spread to Wall Street boardrooms and eventually to main streets around the world. We'll begin with families shopping for homes in the early 2000s, stand beside mortgage brokers offering easy loans, watch investment bankers packaging mortgages into securities, and observe the long, slow build-up of risks that would eventually matter. This will take time, unfolding at the pace that such things actually unfold, one mortgage application at a time, one securitization deal at a time, one slowly rising warning sign at a time. If this story helps you rest tonight, feel free to like or subscribe, though there's no pressure. I'm always curious where you're listening from, so if you feel like it, comment your city and what time it is there. Perhaps you're in a home whose value fluctuated during these years, or perhaps you're too young to remember, learning about events that shaped the economy you inherited. Dim the lights now if you haven't already. Adjust your pillow. Maybe turn on a fan for some gentle background noise, or let the silence settle around you like the quiet of a foreclosed house after the family has moved out, empty rooms holding memories. We have over a decade of financial history ahead of us, but we'll take it slowly, one decision at a time, one consequence after another. Let's begin. Imagine you are walking through a newly built subdivision in Henderson, Nevada, perhaps 2002 or early 2003. The specific date matters less than the atmosphere of the moment. The development is called something hopeful, Vista Ridge or Desert Bloom or Sunset Hills, names suggesting vistas and blooms and hills, though the land is flat desert, scraped and graded for construction. The houses are variations on 3 or 4 basic models, stucco exteriors in beige and tan, red tile roofs, 2-car garages, small yards with desert landscaping not yet installed. The smell is of new construction, fresh paint and drywall compound, carpet being rolled out in empty rooms, the particular scent of new homes that suggests possibility and beginning. The sounds are hammers and air compressors, radio playing classic rock from a construction crew's truck, the backup beeping of a cement truck, occasional shouts between workers coordinating. The weather is sunny, perhaps slightly too hot, even in spring, the Nevada sun bright and optimistic, the sky that particular shade of blue that suggests endless possibilities and no clouds on any horizon. You're here with your family shopping for homes, having driven from your apartment to look at models. The drive took 20 minutes, passing through older neighbourhoods and commercial strips before reaching this new development on what was recently empty desert. Your children are in the back seat, excited about the possibility of having their own rooms, having heard you and your spouse discussing the move for weeks, their anticipation building with each mention of the new house. The real estate agent is enthusiastic, a woman in her 40s wearing professional casual clothes, business cards in her pocket, driving a new SUV that gleams in the parking area. She's been selling homes in this development for 6 months, and business is excellent, every house selling within weeks, sometimes multiple offers, prices rising with each phase of construction. Her commission checks have been substantial, allowing her to upgrade her own home, to take her family on vacations, to feel the satisfaction of success in a booming market. She shows you the model home, professionally decorated by a staging company, furniture carefully selected and arranged, the kitchen gleaming with granite counters and stainless steel appliances that catch the light streaming through windows. The master bathroom features a soaking tub and separate shower with glass doors, the kind of luxury that was once reserved for wealthy homes, but is now standard in new construction at this price point. The carpet is thick and new, the paint smell is strong. The whole space feels expensive and aspirational, designed to make you imagine your life here, your family gatherings, your quiet evenings, your accumulated memories. Your children run through rooms, their voices echoing in the empty spaces, excited by the newness, by the possibility of having their own bedrooms, by the small pool visible through the back sliding door. They've been sharing a room in the apartment, dealing with cramped quarters, and the prospect of space is thrilling to them in ways that adults who've forgotten childhood constraints might not fully appreciate. The asking price is higher than you expected, the number making you pause, making you calculate mentally whether you can afford it. But the agent explains that prices have been rising steadily, that this is an investment, not just a home, that real estate always appreciates over time. At least that's what everyone believes in this moment in 2003. She shows you comparables, houses in this neighbourhood that sold 3 months ago for less than current asking prices, demonstrating the upward trajectory that seems unstoppable, that makes waiting seem foolish, that creates urgency. She mentions low interest rates, how much house you can afford with current mortgage rates in the low fives, how the monthly payment would be manageable even though the total price seems high. She has a calculator, shows you the numbers, demonstrates that you qualify for this loan, that the payment is actually less than you might expect given the price, the magic of low interest rates and long amortization making expensive homes seem affordable. You discuss it quietly with your spouse while the agent gives you space, wandering outside to make a phone call, giving you privacy that's also pressure. Time to decide without explicit watching, but with the knowledge that she's waiting, that other buyers might appear, that opportunity might pass. The apartment is too small, you agree on that. The schools are better here in Henderson than where you currently live. Owning builds equity, while renting builds nothing. All the arguments for buying that everyone makes in this era. The agent returns, sensing interest in the way you're lingering, looking at rooms again, discussing rather than leaving. She mentions that if you're interested, you should decide quickly. Another family looked yesterday, expressed serious interest. The builder is releasing the next phase soon, and prices will be higher. The implication being that this is the best moment to buy, that waiting costs money in the form of appreciation you'll miss. The decision is made, not quite impulsively, but faster than major decisions usually happen, driven by the sense that waiting means missing opportunity, that the market is moving and you need to move with it, that everyone is buying and those who don't will be left behind, priced out, regretful. You tell the agent you want to proceed. She smiles, congratulates you with genuine warmth, begins the process that will end with you owning a home, or more accurately, owing a bank for a home, the distinction unclear in the excitement of the moment. The next scene is a mortgage broker's office, a few weeks later. The office is in a strip mall, between a nail salon where you can hear the drill sounds faintly through the wall, and a Chinese restaurant whose lunch special signs are visible through the window. The kind of anonymous retail space that could house any small business, generic in its layout, functional in its purpose. The sign outside reads American Dream Mortgage or Easy Home Loans, or something equally optimistic, promising service in English and Spanish, advertising rates starting at 4.5%, the numbers large and attention-grabbing. Inside, the office is furnished practically, desks with computers showing colourful screensavers when idle, filing cabinets lining one wall, motivational posters about home ownership and achieving dreams, family photos on desks showing the brokers with their own families, their own homes, living the success they're helping clients achieve. The smell is of coffee from a pot that's been sitting on the burner too long, and toner from a busy printer, papers, and folders stacked on surfaces. The organised chaos of a business processing volume. The sounds of phones ringing, sometimes being answered, and sometimes going to voicemail, keyboards clicking as applications are entered into systems. The broker on another call wrapping up before your appointment, promising the person on the line that approval will come through, that the process is simple, that home ownership is within reach. The fax machine beeps occasionally as documents arrive from lenders or title companies, the technology already outdated but still in use, the paper emerging slowly with its characteristic whine. The mortgage broker is friendly, early 30s, successful looking in business casual attire, dress shirt without tie, slacks, leather belt, the uniform of someone who works professionally but not in a corporate tower. He's been in the business for 3 years, previously sold cars at a dealership, found mortgages more lucrative and more satisfying, helping families achieve home ownership feeling more meaningful than selling vehicles. His walls display certifications and lender partnerships, logos of big banks and mortgage companies, awards for sales volume, the credentials that build credibility. He has you sit in chairs across from his desk, offers coffee which you decline, begins the application process with practiced ease, the questions flowing naturally, the computer screen angled so you can see it, the impression of transparency and partnership. He asks about income, employment history, assets in bank accounts, debts including credit cards and car loans. You answer honestly, providing pay stubs and bank statements, documents you brought as requested in the phone call scheduling this appointment. He types into his computer numbers and fields filling in. His system connected to multiple lenders who compete for your business. The software giving him instant access to loan products from dozens of sources. He explains different loan options, 30-year fixed-rate mortgages with consistent payments over the full term, 15-year fixed with higher payments but faster equity building, adjustable rate mortgages with lower initial payments, interest-only loans where you pay only interest for years. The array of choices somewhat overwhelming to someone unfamiliar with mortgage products. Your income is adequate but not quite enough for the conventional loan the house price requires, the debt-to-income ratio slightly above what traditional underwriting allows. The broker doesn't seem concerned, his expression remaining confident, his tone suggesting this is routine, that solutions exist. He suggests a stated income loan, explaining that for self-employed people or those with complex income streams, documentation can be simplified, the lender trusting borrowers to accurately report income without requiring extensive verification. You're not self-employed, you work a regular job with W-2 wages, but he explains the lender is flexible, understands that people know their own financial situation best, that the process is easier and faster with stated income, that many borrowers use this option. The income you state on the application is higher than your actual income, not dramatically, but enough to qualify for the loan amount you need, the number feeling uncomfortable but rationalised as representing future raises, potential bonuses, your spouse's income potential if they return to work after the children are older. The broker types it in without questions, no furrowing of brows, no requests for additional documentation, the system generating a preliminary approval almost instantly. The automated underwriting system accepting the application based on credit score and stated income and property value. The human judgment that might have raised concerns replaced by algorithmic acceptance. He also suggests an adjustable rate mortgage, an ARM, with a low introductory rate for 2 years, much lower than fixed rates, the teaser rate making the monthly payment very manageable, fitting comfortably within your budget, even with the stated income. You express concern about what happens when the rate adjusts after 2 years, the payment potentially jumping significantly. And he reassures you with confidence that comes from repetition, from having given this answer to dozens of borrowers with the same concern. In 2 years you can refinance, he explains. Home values will be higher based on the consistent appreciation of recent years. You'll have equity. Getting a new loan will be easy, possibly with better terms than available now. Everyone refinances before the adjustment, he says. It's standard practice, part of the strategy, nothing to worry about. The temporary nature of the initial rate is presented as a feature, not a bug, a way to access home ownership now while planning to optimize later. The loan documents are printed, thick stacks of paper emerging from the printer, the rhythmic sound of pages accumulating, disclosures and agreements, promissory notes and deeds of trust, truth in lending statements and good faith estimates. The broker organizes them with practiced efficiency, uses colored tabs to mark signature lines, creates a structured packet that guides you through signing. He points where you sign, explaining key terms quickly, the pace making it difficult to read thoroughly, even if you wanted to, which most borrowers don't. The document's dense with legal language and financial terminology, designed for attorneys, not first-time home buyers. The APR is mentioned, but the calculation is complex, including fees and costs averaged over the loan term, the number higher than the rate but the significance unclear. The introductory rate is emphasized, the low payment highlighted, the future adjustment rate disclosed but minimized, mentioned but not dwelt upon, compliance with regulations achieved through disclosure, even if understanding isn't guaranteed. You sign page after page, your hand beginning to cramp, trusting the process, trusting the system that millions of Americans use to buy homes, trusting that the broker and lender and regulators have ensured this is appropriate, that you wouldn't be approved for a loan you can't afford. The signatures accumulate, the stack of signed documents growing, the commitment becoming real with each mark of the pen. Within weeks, the loan funds, the closing happens at a title company office, another conference room with another stack of documents, more signatures, wire transfers moving hundreds of thousands of dollars between accounts with electronic speed, keys transferred, congratulations from everyone involved, the real estate agent and the sellers and the title officer, everyone benefiting from this transaction in various ways. You own a home, or begin the 30-year process of owning a home, the distinction unclear in the excitement of the moment, the celebratory mood not conducive to parsing the difference between owning and owing. The first mortgage payment is manageable, the house fills with your furniture and your family, life continues with the satisfaction of having achieved something substantial, having bought into the American dream that you've been told is the foundation of prosperity and stability, the proof of middle-class success. Time passes. You find yourself now in multiple roles, observing this process from different angles, experiencing the machinery of the housing boom from various positions. Imagine you're a real estate appraiser, driving through neighborhoods in your area, clipboard on the passenger seat, camera and measuring tape in a bag, assigned to value properties for mortgage purposes. Your job is to determine fair market value, to protect lenders from overvaluing collateral, but the pressure is subtle and constant to come in at or above the contracted purchase price, to enable transactions rather than prevent them. You arrive at a house on a suburban street, parking in the driveway, gathering your materials. The house is similar to dozens of others you've appraised this month. Standard construction, 3 bedrooms, 2 baths, 2-car garage. Nothing special or distinctive. The builder probably constructed 100 houses from this same plan, slight variations in colour and landscaping the only differences. You measure rooms according to standard procedures, note condition of various components, photograph exteriors and interiors, Gather the data that feeds into valuation models you'll use later. The comparable sales are the key, recent transactions of similar properties used to estimate value. You pull comps from your database, houses within a mile radius sold in the last 6 months, adjusted for differences in size and condition and features. The market has been rising steadily. Each month's sales are higher than the previous month's, the trend line pointing up consistently and predictably. The comps support a value that matches the purchase price or exceeds it, your report validating the transaction, enabling the mortgage to fund, the gears of the machine turning smoothly. But occasionally you encounter a situation where the comps don't quite support the contracted price, where the buyer is paying more than recent sales suggest the house is worth, where your professional judgment says the value should be lower than the amount needed for the loan. The pressure comes indirectly, professionally, politely, but clearly. The mortgage broker calls to discuss your report, mentions that the buyer is counting on this transaction, has already given notice at their apartment, that maybe you missed a comparable, that maybe the adjustments are too conservative, that perhaps you could reconsider. The lender's underwriter calls with questions, suggesting that if the appraisal comes in low, the loan won't fund, the buyer will be disappointed, possibly lose their deposit, future business from this broker might go elsewhere, to appraisers who are more flexible, who understand that values are subjective, that different professionals might reach different conclusions. The pressure is never explicit threats, but the implications are clear: cooperate or lose business, enable transactions or be replaced. You adjust the report, finding a comp that was perhaps less similar but sold for more, reducing the downward adjustments, increasing the upward adjustments, massaging the numbers into alignment with the purchase price. The compromise is small, $10,000 or $20,000 in a $400,000 valuation, barely 5%, easily rationalized. The market is rising anyway, so even if you're slightly high today, it will be accurate in 3 months. The appreciation covering any overvaluation, no harm done. You submit the report, the loan funds, everyone is happy. You get paid your fee and move to the next assignment, the cycle repeating. This process occurs thousands of times daily across the country. Appraisers under pressure, values inflating gradually, the feedback loop of rising prices, justifying rising appraisals, justifying rising prices, continuing, reinforcing, accelerating. The checks and balances that might slow this process are weakened by the volume of transactions, the pressure to keep the machine running, the fact that in the short term, everyone benefits from higher values. The rhythm of this era has its own quality, a tempo that defines daily life for millions. Saturday mornings, families drive through neighbourhoods, looking at open houses, imagining their lives in different spaces, their children in different schools, their commutes from different locations. Real estate agents prepare homes for showing, baking cookies to create welcoming smells that psychological studies show increase positive emotions, staging rooms to look spacious and inviting, removing family photos so buyers can imagine themselves in the space. The open house signs go out early, arrows directing traffic, balloons sometimes attached for visibility. The stream of visitors arrives throughout the day, couples and families walking through, opening closets, testing faucets, imagining furniture placement, discussing in whispers whether this is the one. The agent answers questions about schools and property taxes, provides information sheets, collects contact information, assesses who is serious versus merely curious, who might make offers versus who is just beginning to look. The mortgage applications flow steadily into brokers' offices, dozens per week per broker, the approval rate high, the standards flexible, the system designed to say yes more often than no. The brokers process paperwork efficiently, having refined systems, using software that automates much of the workflow, submitting to multiple lenders simultaneously to get the best rates, moving deals through pipelines that close in weeks rather than months. The construction crews work long hours, overtime common, developments growing from dirt lots to completed neighbourhoods in months. The framers arrive first, putting up wooden skeletons rapidly, the structures rising almost visibly. Then electricians and plumbers, running wires and pipes through walls, then drywall installers creating smooth surfaces, then painters applying colours chosen from limited palettes, neutral tones that appeal broadly, then flooring, cabinets, fixtures, landscaping, the final touches that transform construction sites into homes. The title companies schedule closings back to back, conference rooms used continuously from morning to evening, the ritual of ownership transfer happening repeatedly, each ceremony nearly identical. Documents are signed, explained minimally, the legal language incomprehensible to most participants, but the process familiar to the professionals, the title officer, and the agents, and the lender representative, everyone knowing their roles, performing them efficiently. The financial infrastructure supporting this boom operates invisibly to most participants, complex machinery working behind the scenes. The mortgage originators don't intend to hold the loans they make. The business model is originate to distribute, make the loan and sell it quickly, use the proceeds to make more loans. The buyers of these loans are often large banks or Wall Street firms accumulating mortgages to package into securities, the loans becoming raw material for financial engineering. Years pass. You now find yourself on Wall Street, working for an investment bank in the mortgage-backed securities division. Your office is in a tower in Manhattan, floor-to-ceiling windows showing city views that would be expensive to rent as residential space, but serve as backdrop for high finance work, rows of desks with multiple monitors per trader, Bloomberg terminals glowing with market data, screens filled with numbers and charts and news feeds, the constant hum of activity and information. The mortgage-backed securities business has existed for decades, created by government-sponsored enterprises like Fannie Mae and Freddie Mac, a way to turn illiquid mortgages into liquid tradable securities, to spread risk broadly, to make capital available for housing finance. But in recent years the business has expanded dramatically, private label securitization growing, investment banks bundling mortgages from non-government sources, creating MBS from subprime and Alt-A loans that government agencies wouldn't guarantee, the volume and complexity increasing as the housing boom accelerates. Your job involves structuring these deals, working with teams of quantitative analysts who build mathematical models, legal specialists who draft documentation, rating agency liaisons who negotiate ratings, sales teams who market securities to investors. The process begins with acquiring mortgages, your bank buying pools of loans from originators around the country, thousands of mortgages with different characteristics, different borrowers with different credit scores, different properties in different locations, different loan terms and interest rates. The mortgages arrive as electronic data files, borrower information and loan terms and payment histories, abstractions rather than actual people in actual homes. The structuring is mathematical, using computer models to simulate cash flows under various scenarios, to predict how borrowers will behave, to estimate defaults and prepayments and losses. The pool of thousands of mortgages is sliced into tranches, layers with different priority of payment and therefore different risk and return profiles. The senior tranche gets paid first from the cash flows, considered safest, rated AAA by rating agencies, sold to conservative institutional investors like pension funds and insurance companies seeking safe yield. The mezzanine tranches get paid after the senior tranche, riskier, rated A or BBB, sold to investors seeking higher yields in exchange for accepting more risk. The equity tranche absorbs first losses, riskiest piece, unrated or rated below investment grade, held by the investment bank, or sold to hedge funds willing to take substantial risk for potential high returns. The mathematical elegance is satisfying to you and your colleagues, professionals who appreciate structure and logic, the diversification logic compelling and seemingly robust. With thousands of mortgages from different states, different borrowers with different credit profiles, different property types, different loan originators. The pool is supposedly safe through diversification, defaults in one subset, offset by performance in others, the law of large numbers reducing risk. The senior tranches are sized conservatively to withstand significant losses before being impaired. The rating agency models confirming the safety with AAA ratings. The institutional investors' guidelines allowing purchase of AAA securities, the system aligned. The conference rooms where you work smell of coffee, and occasionally lunch brought in during long structuring sessions, Chinese food or pizza, meals eaten at desks while reviewing spreadsheets. Multiple monitors show different aspects of the deal, one with the cash flow model, another with legal documents, another with email, another with market data, the information density requiring multiple screens. Legal teams participate on speakerphone, discussing documentation, defining terms, addressing potential issues, their offices in different buildings or cities, but connected electronically. Rating agency analysts call with questions about the mortgage pool, the underwriting standards, the geographic distribution, the historical performance data, their approval necessary for the AAA rating that makes the deal feasible. The work is intense but intellectually engaging, deals structured over weeks or months, each one different in details but similar in structure. The variations on a theme that becomes familiar through repetition. The deals are marketed to investors through roadshows and presentations, glossy books describing the transaction, pitch meetings where you explain the structure and answer questions, pricing that reflects supply and demand, and the current market environment. Then the closing, with wire transfers moving hundreds of millions of dollars, securities distributed to investors, the deal done, ready to move to the next one. The fees are substantial, the investment bank earning origination fees, structuring fees, underwriting fees, distribution fees, servicing fees, every stage of the process generating revenue. You receive a bonus at year end that reflects deal volume and profitability. Your compensation rising with the market, 6 figures growing towards 7 figures, making the long hours and complex work feel worthwhile. The sense of being at the center of financial innovation, of creating instruments that make housing finance more efficient, of contributing to making the American dream accessible to more Americans, provides satisfaction beyond the financial compensation, a sense of purpose that justifies the work. But questions arise occasionally, usually late at night when reviewing data or running scenarios, when the models show results that seem optimistic, when assumptions feel aggressive. The models assume defaults will be independent across the mortgage pool, that geographic diversification eliminates correlation between mortgages. But what if a nationwide economic shock affects all regions simultaneously? The models assume home prices will continue rising or at least remain stable, but what if prices fall significantly? The models use historical default data from periods when prices rose, when refinancing was easy, when home equity provided cushion, but that historical data may not capture behavior in a severe downturn. You raise these concerns in team meetings, and they're acknowledged, senior people nodding, agreeing that these are valid points, but the response is ultimately reassuring rather than actionable. The senior tranches are structured to withstand significant losses. 20 or 30% of the pool could default before the AAA tranche loses money. The historical default rate for prime mortgages is very low. Under 1%, even subprime defaults historically have been manageable. The yields compensate investors for risk. The rating agencies, with their sophisticated models and deep expertise, have validated the structures with AAA ratings, suggesting the risk is truly minimal. The market is functioning smoothly, investors are buying eagerly, demand often exceeding supply, pricing reflecting confidence. The system works, proven by its operation, validated by participation from sophisticated institutional investors who have their own risk managers and due diligence processes. Your concerns are noted but not acted upon, the machine continuing, accelerating, the volume growing quarter after quarter. The trading floor culture reinforces confidence and optimism. The traders who generate the most revenue are celebrated, bonuses reflect profitability, success breeds more aggressive risk-taking as successful strategies are scaled up. The tail risk, the low probability catastrophic scenario, is discussed in risk committee meetings but doesn't affect day-to-day decisions, doesn't slow deal flow, doesn't change the fundamental trajectory. Everyone knows that eventually the music will stop, that cycles turn, that booms end, but while the music plays, the imperative is to keep dancing. The competition for market share driving behaviour, even when individual judgment might suggest caution. Time moves forward. You now find yourself in an even more complex realm, the world of collateralized debt obligations, CDOs, securities built from other securities, financial abstraction layered on financial abstraction. These instruments emerge from structuring desks trying to solve a problem. The mezzanine tranches of mortgage-backed securities are difficult to sell, investors wanting either AAA safety or equity upside, not the middle ground of BBB or A-rated bonds that offer moderate returns for moderate risk. The solution is elegant from a financial engineering perspective, brilliant in its complexity, seemingly sophisticated in its risk management. Gather the mezzanine tranches from multiple MBS deals, pool them together creating diversification across diversified pools, slice this new pool into tranches using the same methodology as MBS structuring. Get the senior slice rated AAA by rating agencies. The diversification logic applies recursively. Losses would hit different underlying mortgage pools at different times. The senior tranche of the CDO would be protected by the junior CDO tranches, absorbing losses first. The mathematical models validate the structure. Institutional investors accept AAA ratings and buy the paper. You work on structuring a CDO, the process taking months from initiation to closing. The selection of assets requires analysis, examining hundreds of MBS tranches to identify appropriate ones for the pool, running correlations between underlying mortgage pools, modelling cash flows under various scenarios. The legal work is extensive, drafting prospectuses that run hundreds of pages, negotiating documents with trustees and servicers, defining waterfall structures that specify how cash flows to different tranches, addressing potential edge cases and legal issues. The rating agency presentations are crucial, meetings where you explain the CDO structure, respond to questions about asset selection and correlation assumptions and structural protections, negotiate ratings that make the deal feasible. The agencies run their own models using their proprietary methodologies, assess the diversification and structural features, assign provisional ratings that allow marketing to begin but can be adjusted based on final asset selection. The prospectuses are massive documents detailing the assets in the pool, the structure of the CDO, the risks to investors, the legal terms governing the transaction, information disclosed to satisfy securities regulations. The documents are so complex and lengthy that almost no one reads them thoroughly, investors relying instead on rating agencies' AAA designations, trusting that someone has done the analysis, that the ratings reflect genuine assessment of risk. The complexity is both a feature and a concern, sophisticated enough to satisfy regulatory requirements and legal teams, opaque enough that true understanding requires enormous effort that few are willing to invest. The closing happens in a conference room, participants gathering for the final signatures and wire transfers, a ritual that marks completion of months of work. The investment bank's legal team, the trustees' representatives, the CDO manager if it's a managed deal where someone actively selects and trades the assets, everyone signing documents, reviewing closing checklists, confirming that all conditions have been met. Wires transfer securities, and cash, the CDO, is born. Investors own tranches, the bank earns its fees. Your bonus will include a portion of the fees from this deal and others you worked on, compensation reaching high six figures, perhaps seven figures in a good year, money that seems earned through months of complex technical work, but also somewhat disconnected from the underlying reality of homeowners making mortgage payments on houses in subdivisions across America. The abstraction makes it easy to forget that these complex securities ultimately depend on real people making real payments, that all the structuring and modelling and rating doesn't change that fundamental dependency. Some deals become even more abstract. CDO squared, CDOs of CDOs, taking tranches of CDOs and pooling those into new CDOs, a second layer of abstraction, complexity compounding on complexity. You work on one such deal, the mathematical models accepting the correlations and assumptions from the underlying CDOs, treating them as inputs, building another layer on top. CDOs. The rating agencies approve these structures, investors buy them, the system validating itself through its own functioning, the market's willingness to purchase these securities offered as proof they must make sense. Economists and financial historians will later debate whether these structures were designed deliberately to obscure risk or were genuine attempts at risk management that failed unexpectedly under extreme conditions. The participants at the time generally believed they were creating value, improving market efficiency, managing risk through sophisticated diversification and structuring. The fees and compensation created powerful incentives to continue, but most people involved thought the models were sound, the ratings were accurate, the system was working, the risks were genuinely reduced through structuring rather than merely hidden through complexity. Remember those families buying homes in 2003? By 2006, many have refinanced, extracting equity, using the cash for various purposes. The dinner party conversations reflect the wealth effect, everyone feeling richer, spending more freely, the economic stimulus of rising home prices flowing through consumption patterns. The warning signs are subtle, easy to dismiss, rationalized as temporary corrections in an overheated market that remains fundamentally strong. The story continues, but rest comes easier knowing these cycles repeat, that patterns emerge gradually, that understanding comes slowly even for participants who eventually realize that something built on optimism and assumptions may prove less stable than believed in the moment. Months have passed since that optimistic peak, time flowing forward through the seasons of late 2006 into early 2007, carrying with it changes that at first seem minor, perhaps even imaginary. The kind of shifts that are only obvious in retrospect when the pattern has fully emerged. You now find yourself watching a subtle shift, almost imperceptible at first, like the moment when afternoon light begins to fade into evening, but you don't notice until shadows have lengthened considerably, until the quality of light has changed enough that suddenly you realize it's later than you thought, that time has passed without your full awareness. The housing market that seemed destined to rise forever, that functioned with the seeming inevitability of a natural law, prices moving in only one direction, like gravity, pulling objects downward but reversed, always up, always higher, month after month, year after year, creating wealth without effort, rewarding ownership simply through passage of time. That market is now hesitating, pausing in its upward trajectory, and in some places, particularly those that rose fastest during the boom, beginning to decline. The change gradual enough that many participants don't recognize it initially, don't want to recognize it, attribute variations to seasonal patterns or temporary corrections or anything but the beginning of something more significant and more troubling. The psychology of denial is powerful when financial security depends on believing a particular narrative. Homeowners whose net worth is mostly housing equity, whose retirement plans depend on continued appreciation, whose sense of having made good decisions rests on the assumption that real estate always goes up. These people have strong motivation to interpret softness as temporary, to believe that the fundamental dynamic hasn't changed, that this is just a pause before the next leg up. The real estate agents whose commissions depend on closed transactions, the mortgage brokers whose income depends on loan volume, the appraisers whose business depends on satisfied clients, the entire ecosystem built around rising prices has structural incentives to minimize bad news, to emphasize positive signs however slight, to maintain confidence even as evidence accumulates that something has changed. But the evidence does accumulate slowly, quietly, in statistics and anecdotes and personal observations that are individually dismissible but collectively significant. The inventory of unsold homes rises month by month through late 2006, houses staying on market longer, the quick sales of previous years replaced by longer marketing periods, sellers reducing asking prices to attract buyers who are becoming scarce. The number of building permits declines as developers realize that demand is softening, that starting new projects in this environment is risky, that the guaranteed profits of recent years are no longer guaranteed. The home price indices, published monthly by various sources, show appreciation slowing dramatically. The double-digit annual gains of 2004 and 2005 becoming mid-single digits in 2006, becoming flat or slightly negative in some markets by early 2007. The Case-Shiller Home Price Index for major metropolitan areas, widely watched by economists and investors, begins showing year-over-year declines in some cities. The line on charts that pointed steadily upward for years now horizontal or beginning to curve downward, the visual representation of changing fundamentals. The media coverage shifts tone gradually. The real estate sections of newspapers that celebrated the boom, that featured success stories of people who bought and sold for profits, that showed happy families in new homes, begin featuring different stories. Articles about rising inventory, about sellers struggling to find buyers, about price reductions, the shift in narrative reflecting and reinforcing the shift in market dynamics. The CNBC coverage that was relentlessly bullish about housing begins including skeptical voices, economists warning about overvaluation, analysts discussing the risks. Though the optimists still dominate most broadcasts, the consensus being that housing might cool but won't crash, that prices might flatten but won't fall significantly, that America hasn't seen a national housing price decline since the Great Depression, and this time won't be different. Imagine you're a homeowner in early 2007, sitting at your computer in your home office, or at the kitchen table checking home prices online as you've done regularly for years. The routine as familiar as checking email or browsing news. The habit formed during years when checking prices brought satisfaction, when each check showed your home worth more than before, when the number rising steadily provided psychological comfort and sense of growing wealth. You type your address into Zillow, wait for the estimate to load, and notice the number is lower than last month. You refresh the page thinking it's an error, a glitch in the website's algorithm, but the number persists. Your home's estimated value down $5,000 from the previous estimate, down $15,000 from 6 months ago. Your neighbour's house sold recently, but the process took 3 months, far longer than the weeks that were typical last year, and the final price was 10% below asking, below what comparable houses sold for a year ago. The for sale sign stood in the yard for months, becoming weathered, the optimistic open house flags fading in the sun, eventual price reductions indicated by new riders added below the original sign, the visible markers of a changing market. The realization forms slowly, reluctantly, that something is changing, that the pattern of the last 5 years is breaking, that assumptions about perpetual appreciation may have been wrong. The emotional response is complex, denial mixed with concern, rationalization competing with recognition, the desire to believe this is temporary fighting against evidence that it might not be. Your home is likely your largest asset, your financial security tied to its value, the psychological stake in continued appreciation making it difficult to accept decline. The signs multiply gradually through early 2007. For sale signs stay up longer, weeks turning into months, the lawns beneath them sometimes becoming overgrown as sellers struggle to maintain properties while also paying mortgages. Real estate agents mention that buyers are scarce, that people are waiting to see if prices drop further before purchasing. That inventory is rising as sellers list but buyers hesitate. The construction sites that were everywhere are quieter now, some projects halted mid-development, skeletal frames of houses standing unfinished, construction equipment sitting idle, workers laid off or moved to other projects. The smell of those unfinished developments is different from completed ones, less paint and new carpet, more exposed wood, and standing water in unfinished basements where drainage hasn't been completed, the scent of abandonment mixing with construction materials. The sounds are sparse, occasional workers finishing contracted work, but no new activity starting. The ambient noise of building that defined recent years fading into silence, punctuated only by wind through open framing and occasional security personnel checking the sites. You find yourself as a mortgage broker whose office volume has declined dramatically. The phone that rang constantly in 2005 now rings occasionally. Applications that do come in are often declined, the standards having tightened seemingly overnight. Lenders that accepted stated income loans last year now require full documentation, wanting to see pay stubs and tax returns and W-2s. Verification that was considered unnecessary when appreciation covered all risks. Lenders that offered 100% financing now require down payments of 10 or 20%, money that marginal borrowers don't have. The ARM products that were everywhere are being phased out or repriced to make them uneconomical. Borrowers who need to refinance before rate resets are finding they can't qualify for new loans. The strip mall office feels different now, the energy and optimism of previous years replaced by concern and quiet desperation. You've laid off your assistant, the person who handled paperwork and answered phones and scheduled appointments, their salary no longer justifiable, given the volume decline. You've reduced your own hours, coming in late and leaving early, the empty office depressing, the lack of activity demoralizing. You've considered closing entirely but hope the market rebounds, that this is temporary, that volume will return. The motivational posters on the walls about achieving dreams and home ownership seem mocking now, remnants of an era that ended abruptly, their messages ringing hollow in the current environment. The smell of coffee is the same, the pot still brewing each morning out of habit, but the taste is more bitter, the routine of coming to an office with little to do wearing on your optimism. The phone sitting silent on your desk becomes a source of anxiety, each quiet hour a reminder of business not happening, commissions not earned, bills accumulating. The fax machine that whirred constantly now sits idle, occasionally beeping to life when a lender sends updates about tightened guidelines or program cancellations, bad news arriving electronically. The news begins reporting mortgage company failures with increasing frequency. In February 2007, several dozen subprime lenders announced bankruptcy or closure simultaneously, a cascade of failures as funding dries up and losses mount. Fremont Investment and Loan, which originated billions in subprime mortgages, shuts down. New Century Financial, one of the largest subprime originators, files for bankruptcy in April, its stock having fallen from $30 to pennies, shareholders wiped out. American Home Mortgage, a major Alt-A lender, fails in August, unable to fund its pipeline, forced to liquidate. The employees of these companies show up to locked offices, their security badges no longer working, their jobs disappeared without warning. The industry that expanded rapidly through 2005 and 2006, hiring tens of thousands, is now contracting faster than it grew. Unemployment rising first in mortgage-related jobs, the canary in the coal mine signalling problems spreading to broader economy. The parking lots of these mortgage companies, once full from early morning through evening, now sit empty except for a few cars belonging to management liquidating assets, the physical emptiness reflecting economic collapse. You observe this as someone who works in a bank's loss mitigation department, a department that barely existed 2 years ago but is now overwhelmed with volume, hiring rapidly to keep pace with rising delinquencies. Your job is processing delinquent mortgages, working with borrowers who have stopped paying, trying to modify loans or arrange short sales, or ultimately proceeding to foreclosure when no other options exist. The volume is overwhelming, cases arriving faster than you can process them, the backlog growing despite working overtime, each file representing a family losing their home, the human cost of statistical default rates becoming tangible in thousands of individual stories. The calls are emotionally difficult, talking to borrowers who are often crying, explaining that their ARM adjusted and they can't afford the payment that doubled, that they lost their job in construction or real estate or another industry affected by the housing slowdown, that they tried to refinance but the house is worth less than they owe, leaving them trapped, that they don't know what to do next. You try to help, offering loan modifications that reduce payments temporarily or extend terms or reduce principal in some cases. But most borrowers don't qualify under the bank's criteria, the modifications requiring income sufficient to afford reduced payments, verifiable hardship rather than just inability to pay. The rhythm of this work is grinding, repetitive, emotionally exhausting in ways that pure intellectual work is not. Each morning brings hundreds of new emails from borrowers pleading for help, voicemails from desperate people who called overnight when they couldn't sleep, worrying about losing their homes. Reports showing rising delinquencies across all mortgage products, not just subprime, but Alt-A and even prime, the problems spreading as the economy weakens and home prices fall. Meetings discussing how to handle the volume, whether to hire more staff or accept longer processing times, the difficult trade-offs between cost and service. The office smells of stress, more coffee consumed than usual, people working long hours, the fluorescent lights harsh and unrelenting, the cubicles feeling claustrophobic despite not being physically smaller, the atmosphere weighing on everyone. The company cafeteria conversations are about layoffs in other departments, whether the bank itself will survive if losses continue mounting, what happens if things get worse. The institutional knowledge that banks are sound, that the financial system is stable, is being questioned for the first time in most employees' careers. The foreclosure process itself unfolds slowly, bureaucratically, governed by state laws that vary, but generally provide multiple opportunities for borrowers to cure defaults before final action. Missed payments accumulate, first one which triggers automated letters, then two which trigger phone calls from servicing representatives, then three which trigger notice of default, formal legal notification that foreclosure proceedings have begun. Borrowers often don't respond, overwhelmed by the situation or avoiding reality, sometimes calling in desperation, asking for help that isn't available under program guidelines. The legal process proceeds through state-specific procedures, judicial foreclosure in some states requiring court approval, non-judicial foreclosure in others allowing banks to foreclose without court involvement, the timeline varying from months to over a year depending on state laws and court backlogs. Foreclosure sales are scheduled, often multiple times as borrowers file bankruptcy or seek modifications. Final sales eventually occurring, properties becoming bank-owned, REO, real estate owned, the houses becoming assets on bank balance sheets rather than homes for families. Time passes. You now find yourself on Wall Street, where the confidence of previous years is evaporating, replaced by concern that grows into fear as 2007 progresses. The trading floors that were loud with shouted orders and confident banter are quieter now, worried murmurs replacing confident shouts. Traders huddle around monitors, watching prices decline. Risk managers run scenarios trying to quantify exposures. The Bloomberg terminals show mortgage-backed securities prices declining steadily. CDO tranches that were rated AAA trading at significant discounts if they trade at all, liquidity disappearing as buyers vanish. The mechanics of the unfolding crisis are complex, but the symptoms are visible everywhere in the financial system. Banks hold billions in MBS and CDOs on their balance sheets, valued at par based on AAA ratings from agencies, but the market prices are far lower, deep discounts reflecting revised risk assessments. Mark-to-market accounting rules require valuing securities at market prices, forcing write-downs of billions of dollars, eroding capital, raising questions about solvency. The banks resist these write-downs initially, arguing that securities are temporarily distressed but fundamentally sound, that marking to fire sale prices doesn't reflect true long-term value, that patient holders will eventually be repaid in full. The auditors and regulators disagree, demanding realistic valuations that reflect actual market conditions. The conflict producing quarterly earnings reports that shock investors. In March 2008, Bear Stearns fails, the fifth largest investment bank, 85 years old, collapsing within days when counterparties refuse to do business with them. Short-term funding dries up, the firm hours away from bankruptcy. The Federal Reserve, acting under Depression-era authorities not used in decades, arranges emergency financing for JP Morgan to acquire Bear over a weekend, preventing the chaotic bankruptcy that officials fear would cause systemic collapse. The acquisition price is $2 per share initially, raised to $10 after shareholder outcry, compared to $170 a year earlier, effectively wiping out equity holders, employees holding stock options losing their savings. You watch this as a Bear Stearns employee, arriving Monday morning, March 17th, to find your company has been sold over the weekend, your stock options worthless, your career interrupted without warning. The building is surreal, people gathering in conference rooms, watching CNBC coverage, seeing their lives reported as financial news, trying to understand what it means for their jobs, their mortgages, their futures. Some colleagues cry openly, others are angry, many are simply numb, processing a change too abrupt and complete to fully absorb. Security is tighter, preventing unauthorized access. Reporters camped outside, hoping to interview employees. The building that was your professional home for years suddenly feeling hostile and unfamiliar. The broader market reacts with temporary relief that Bear didn't fail chaotically, that the Fed intervened preventing contagion, that the system held. But concern remains about which firm might be next, about whether problems are contained at Bear or systemic across Wall Street, about whether other investment banks face similar funding pressures. Other firms examine their exposures, their funding sources, their contingency plans, stress test their liquidity. The question shifting from whether there will be more problems to when and where they'll emerge. Remember those CDO structures from 2006. Many are now failing spectacularly, tranches that were rated AAA experiencing losses as underlying mortgages default, the models having proven catastrophically wrong about correlation and diversification. The assumptions that defaults would be independent, that geographic diversification protected against systemic risk, that senior tranches could withstand severe stress, all proved incorrect when home prices fell nationwide, when correlations approached 1, when diversification provided no protection against systemic shock. Summer 2008 is tense, markets volatile, banks reporting quarterly losses measured in billions, housing prices still falling with no bottom visible, foreclosure filings accelerating month after month. Fannie Mae and Freddie Mac, the government-sponsored enterprises that guarantee or own roughly half of all mortgages in America, are placed into conservatorship in September. Effectively nationalized, their shareholders wiped out, the government directly backing their obligations to prevent catastrophic losses to mortgage-backed securities holders worldwide. The action stabilizes mortgage markets temporarily, but signals that problems are far worse than officially acknowledged. Then comes the weekend that changes everything, September 13th to 14th, when Lehman Brothers faces collapse. The firm, fourth largest investment bank, 158 years old, has been losing money for quarters, unable to raise sufficient capital, its stock price collapsing from $60 to single digits, counterparties pulling back, refusing to trade with Lehman, the death spiral of lost confidence accelerating beyond control. Emergency meetings at the Federal Reserve Bank of New York bring together Treasury Secretary Paulson, Fed Chairman Bernanke, banking CEOs, desperate attempts to arrange a private sector solution, seeking buyers for Lehman, hoping to avoid government rescue. You observe this as a Lehman employee, watching news over the weekend, hoping for rescue, fearing the worst. Bank of America is mentioned as potential buyer, but acquires Merrill Lynch instead. Barclays shows interest, but can't get approval from British regulators for the guarantees necessary to close quickly. Paulson announces no government money will be provided, that Lehman must find private solution or face bankruptcy. Sunday evening, the news reports that no deal will happen, that Lehman will file bankruptcy Monday morning, the largest financial bankruptcy in history. Monday, September 15th, 2008, Lehman Brothers, Files, Chapter 11, Bankruptcy, $639 billion in assets, $619 billion in debts, over 25,000 employees globally facing job loss. You arrive at Lehman's headquarters to find media surrounding the building, cameras filming employees entering, reporters asking for comments. The office is chaos controlled by security, some employees already packing boxes, others standing around watching screens, the disbelief palpable despite having expected this outcome over the weekend. The building that was centre of your professional life for years is now a crime scene in financial terms, the firm dead, your job ending immediately, your stock and options worthless. Years of accumulated wealth in company stock evaporated. The market reaction is immediate and severe. Stock indices plunge, the Dow dropping over 500 points. But more concerning is credit markets freezing completely. Banks stop lending to each other overnight. The interbank market that usually functions automatically seizes up, institutions hoarding cash rather than lending even to credit-worthy counterparties. LIBOR, the rate banks charge each other for short-term loans, spikes to levels indicating banks believe other banks might fail overnight. The fundamental trust underlying financial system evaporating. The consequences cascade rapidly. Money market funds, supposedly safe cash management vehicles where companies and individuals park liquidity earning minimal interest, begin breaking the buck. Net asset values falling below $1 per share due to holding Lehman commercial paper that is now worthless. The Reserve Primary Fund, oldest money market fund, announces it will liquidate at 97 cents per dollar, causing panic among investors who thought money market funds were essentially equivalent to bank deposits. Massive withdrawals begin, $200 billion fleeing money market funds in days, the safe haven suddenly perceived as risky. The commercial paper market, where corporations fund daily operations through short-term borrowing, freezes completely. Companies unable to roll over maturing paper face liquidity crunches even though they're operationally sound, the financial plumbing that enables commerce clogging. General Electric, one of most creditworthy corporations, struggles to issue commercial paper, signalling that if GE can't borrow, nobody can. The oxygen of business activity is becoming scarce, the financial system is stopping, the real economy is beginning to seize. AIG, the giant insurance company, faces collapse the next day, Tuesday, September 16th. The firm sold credit default swaps, essentially insurance against bond defaults, on hundreds of billions of dollars of structured finance securities, including many CDOs, and now faces collateral calls it cannot meet as values plunge and ratings decline. The Federal Reserve arranges an $85 billion bailout, taking 79.9% equity ownership, preventing AIG's failure, which would trigger obligations to counterparties worldwide, potentially destroying multiple other institutions in chain reaction. The following weeks blur together, each day bringing new crises, new emergency actions, the normal rules suspended, the financial system being remade in real time. Washington Mutual, largest savings and loan with $300 billion in assets, is seized by regulators September 25th and sold to JP Morgan, the largest bank failure in US history. Wachovia Teeter's On Brink is acquired by Wells Fargo in October. Merrill Lynch, facing similar fate to Lehman, is acquired by Bank of America under pressure from regulators. Morgan Stanley and Goldman Sachs, last remaining independent investment banks, convert to bank holding companies, accepting Fed regulation in exchange for access to Fed lending windows, the investment banking model effectively ending. Treasury Secretary Paulson and Fed Chairman Bernanke go to Congress in late September requesting $700 billion for Troubled Asset Relief Program, TARP, authority to intervene massively in financial markets to prevent complete collapse. The initial House vote fails September 29th. The market drops 777 points, the largest point drop in history, concentrating congressional minds wonderfully on urgency of situation. A revised bill passes October 3rd, with added provisions to gain votes, authorizing unprecedented government intervention, fundamentally changing relationship between state and markets. The atmosphere in Washington during these weeks is urgent, serious, bipartisan, in ways that seem impossible in normal times when partisan politics dominate every issue. Congressional hearings feature bank CEOs testifying before hostile committees, facing angry questions from representatives whose constituents are losing homes and jobs, the public fury at Wall Street channeled through congressional interrogation. The CEOs, usually confident and commanding in their own boardrooms, appear defensive and uncertain under questioning, their prepared statements sounding hollow against backdrop of economic devastation. Protesters gather outside federal buildings, carrying signs about bailouts and inequality and corporate greed, the populist anger at financial institutions reaching levels not seen since Great Depression. The Occupy Wall Street movement is still years away, but the seeds are planted in this moment, the perception forming that banks were rescued while ordinary people suffered, that the wealthy escaped consequences while middle class bore losses. The demonstrations are mostly peaceful, but the anger is real, palpable, the sense that system is rigged for powerful against ordinary people crystallizing in these weeks. Inside the Federal Reserve and Treasury, the work is relentless. Teams operating around the clock on emergency programs, creating lending facilities with acronyms that will become familiar to market participants. TALF, TARP, PDCF, various mechanisms to inject liquidity into frozen markets, to support specific institutions to prevent cascading failures. The offices never truly close during these weeks, people sleeping on conference room floors when exhaustion overwhelms them, surviving on vending machine food and coffee, adrenaline of crisis management temporarily overriding physical needs. The work is intensely technical, designing facilities that comply with Federal Reserve Act limitations on lending, structuring support that protects taxpayers while stabilizing institutions, negotiating terms with banks that need assistance but resist government involvement, the legal and financial complexity enormous even before considering political sensitivity. The career civil servants and appointed officials work together, differences in expertise and authority less important than shared urgency to prevent collapse. The normal bureaucratic processes compressed by emergency into rapid decision-making that would be impossible in normal times. The international dimension adds complexity, foreign banks holding US mortgage securities facing losses, European institutions requiring dollar funding to meet obligations. The crisis revealing how interconnected global finance has become. Coordinated central bank actions provide dollar swap lines, allowing foreign central banks to provide dollars to their domestic banks, preventing global dollar shortage from causing failures abroad. The Federal Reserve essentially becomes lender of last resort, not just for US, but for global financial system, the role expanding beyond anything envisioned in normal times. The bailouts and interventions spark fierce debates that continue for years. Some economists argue that banks should have been allowed to fail, that bailouts create moral hazard by protecting institutions from consequences of bad decisions, that capitalism requires both profit and loss, that rescuing banks teaches lesson that risks can be taken freely because government will prevent failures. The argument has intellectual coherence and emotional appeal, the sense that justice requires accountability, that fairness demands consequences. Others respond that systemic failure would have caused another Great Depression, that millions of innocent people would have suffered unemployment and foreclosure through no fault of their own. That ideological purity is luxury affordable only when stakes are low, that preventing catastrophic damage to real economy justifies supporting financial institutions despite moral hazards. The argument emphasizes pragmatic consequences over abstract principles, accepting imperfect outcomes as better than catastrophic ones. The economists are divided along these lines and others, some advocating more fiscal stimulus, arguing the initial package is too small, others warning about government debt and future inflation, some supporting aggressive monetary policy, while others fear distorting markets and creating asset bubbles. The uncertainty about proper policy reflects genuinely novel circumstances, historical precedents providing limited guidance, the Great Depression being too distant and too different to apply directly, Japan's lost decade offering warnings but unclear lessons. The rest of the world watches with concern and contagion, the crisis spreading globally despite originating in US housing markets. European banks had purchased large amounts of US mortgage securities, attracted by yields and AAA ratings, now facing massive losses that threaten solvency. British bank Northern Rock had failed in September 2007, the first bank run in UK in over a century. Depositors queuing outside branches to withdraw funds, images reminiscent of 1930s newsreels. Iceland's entire banking system collapses in October 2008, the country's three largest banks failing simultaneously, the currency plunging, the economy requiring IMF bailout, a nation of 300,000 people devastated by exposure to international finance far larger than domestic economy could support. The contagion mechanisms are complex, direct exposures to US securities causing losses, but also indirect effects through funding markets and confidence. European banks relied on short-term dollar funding in wholesale markets, the freezing of these markets after Lehman requiring central bank intervention to prevent failures. The psychological contagion spreads fear globally. If Lehman can fail, then any institution might fail, the confidence that underpins financial system evaporating, replaced by suspicion and hoarding of liquidity. By end of 2008, the economic statistics are grim, each data release worse than previous one. The Dow has fallen nearly 40% from October 2007 peak of over 14,000 to below 8,000, the worst annual performance since 1931. Trillions in market value evaporated, retirement accounts devastated, the wealth effect that boosted consumption during boom now working in reverse. Home prices have fallen 20% nationally from peak, more in hardest hit markets like Las Vegas and Phoenix and Florida, where they've declined 40% or 50%. The correction eliminating years of gains, leaving millions of homeowners owing more than homes are worth. Unemployment is rising toward 10%, job losses accelerating, the labour market deteriorating rapidly as businesses cut costs and defer hiring. The weekly unemployment claims reports becoming feared announcements, each one showing hundreds of thousands of new claims. Consumer confidence has collapsed, measured indices reaching lowest levels on record, households paralysed by fear and uncertainty, cutting spending sharply, the drop in demand causing businesses to cut more, the vicious cycle feeding on itself. Retail sales have plunged, The holiday shopping season of 2008 disastrous for retailers, stores offering deep discounts to move inventory, many chains filing bankruptcy, the shopping malls that were crowded during boom years now eerily empty. Auto sales have fallen off cliff. The Detroit 3 automakers seeking government bailouts to avoid bankruptcy, dealers closing, the industry that was barometer of American manufacturing now symbol of broader distress. Credit card delinquencies are rising as consumers unable to pay, the spending boom of previous years financed by cards now creating payment crisis. The recession that began in December 2007, not recognized officially until a year later, but clear in real-time data, is now understood as Great Recession, deepest downturn since 1930s, more severe than recessions of 1970s and 1980s that had seemed bad at time. The label acknowledges severity while distinguishing from depression, recognizing that despite pain, this remains smaller than 1930s catastrophe, when unemployment reached 25% and GDP fell by a third. But for millions living through it, the distinction between recession and depression is academic. The personal experience of job loss and foreclosure and depleted savings feeling catastrophic regardless of technical classification. The family that loses home to foreclosure isn't comforted by statistics showing this is merely severe recession, not true depression. The worker unemployed for a year doesn't care whether unemployment is 10% or 25% when they personally can't find job. The retiree whose 401k is cut in half doesn't feel better knowing stock market hasn't fallen as much as in 1930s. The human stories accumulate, millions of individual experiences of crisis. The construction worker in Nevada laid off in 2008, unemployment benefits running out, unable to find work in economy where construction has stopped, eventually taking job at Walmart for a fraction of previous income. The path from middle class to working poor traversed in months. The office worker in Michigan whose company downsized, eliminating her position after 15 years, the skills that were valuable yesterday suddenly obsolete or unwanted, the job search yielding nothing, the savings depleted, the house eventually foreclosed, the family moving in with relatives. The recent college graduate entering job market in 2009, degree in hand but unable to find career track position, taking temporary job that becomes permanent underemployment, the student loans coming due, the career trajectory permanently altered by bad timing of graduating into worst job market in generations. The small business owner whose sales collapsed with consumer spending, unable to get credit to bridge slow period, eventually closing business that represented years of work, the dream of entrepreneurship ending in bankruptcy and starting over. The retired couple whose retirement accounts fell by half, forcing return to workforce in 60s, taking part-time jobs to supplement Social Security, the golden years of leisure replaced by necessity of continued work, the plans for travel and relaxation postponed indefinitely or abandoned entirely. The middle-aged worker whose industry contracted, taking early retirement package that seemed generous but leaves decades of reduced income. The comfortable trajectory to retirement replaced by financial uncertainty and constrained lifestyle. These stories repeat across country and across demographics. The crisis spreading through economy affecting nearly everyone, though not equally. The burdens falling heaviest on those with least cushion. The working class and lower middle class bearing disproportionate pain. The wealthy suffer too. Portfolios declining, bonuses disappearing, but wealth provides buffer, the difference between dropping from rich to merely comfortable versus dropping from stable to precarious, the gradient of suffering correlating inversely with pre-crisis wealth. The foreclosure crisis continues accelerating through 2009 and into 2010, peaking at over 2.8 million foreclosure filings in 2010, roughly 1 in 45 households receiving filing, the scale unprecedented in modern history. The foreclosures concentrate in states that had biggest booms: California, Florida, Nevada, Arizona, the markets that rose fastest falling hardest, the geographic pattern reflecting where speculation was most extreme, where subprime lending was most prevalent, where affordability had diverged most from fundamentals. The foreclosed properties become burden on neighborhoods, vacant homes, attracting vandalism and squatters, depressing values of surrounding properties, creating blight in communities, the negative spillovers affecting even responsible homeowners who maintained payments. Some cities are overwhelmed, blocks with multiple foreclosed homes, the social fabric tearing as families leave, as communities disperse, as the stability that home ownership was supposed to provide proving illusory. The government programs to help homeowners are criticised as inadequate. HAMP, Home Affordable Modification Program, helping fewer borrowers than hoped. The eligibility requirements excluding many who need help, the servicer participation inadequate, the modifications often temporary rather than sustainable. The criticism comes from all sides. Some arguing program does too much by rewarding irresponsibility, others arguing it does too little by leaving millions without help. The political impossibility of satisfying anyone when losses must be allocated among borrowers, lenders, taxpayers, and no solution makes everyone whole. The sense develops that banks were rescued but people weren't, that TARP recapitalized financial institutions while homeowners received inadequate help, that the system was rigged to protect powerful institutions at expense of ordinary people. The perception, whether entirely fair or not, shapes political dynamics for years, fueling populist movements left and right, undermining trust in institutions, creating cynicism about government and finance that persists long after crisis ends. Remember those families buying homes in 2003? By 2010, many are either foreclosed or struggling, the dream that seemed achievable having turned into nightmare. The American dream of home ownership revealed as more fragile than imagined, the assumptions underlying the boom proven catastrophically wrong. The anger and pain and disillusionment shape a generation's relationship with housing and finance, the lessons learned through costly experience rather than abstract study. The crisis has now moved from acute phase to chronic aftermath. The immediate fear of systemic collapse replaced by grinding reality of deep recession. The emergency actions of late 2008 having stabilized system but not restored prosperity. The long, slow process of recovery just beginning, years of difficulty still ahead. The story continues, but rest comes easier knowing the worst has passed, that the system survived though battered, that recovery will eventually come. Though slowly, that morning always follows, night, though dawn, may be delayed, and light returns gradually rather than suddenly, the rhythm of crisis and recovery continuing through history as it always has and always will. You now find yourself in 2009, living through what historians will call the Great Recession, the deepest economic downturn since the 1930s, the most severe crisis most participants have experienced in their lifetimes. The statistics, while abstract numbers on spreadsheets and news reports, represent millions of individual stories of disruption and hardship. 8.7 million jobs lost between peak and trough, unemployment reaching 10% officially and higher when counting discouraged workers who stopped looking. Home prices fallen over 30% from peaks nationally, and 50% or more in hardest hit markets. Foreclosures numbering in the millions, with more coming, stock portfolios cut in half, wiping out trillions in household wealth, retirement savings depleted, forcing delayed retirements or returns to work. The numbers accumulate in reports and statistics, but each one represents someone's life disrupted, someone's plans derailed, someone's financial security undermined. The unemployment rate rising month after month through 2009 represents families losing income, homes at risk, futures uncertain, the aggregate statistics composed of individual tragedies playing out across neighbourhoods and communities nationwide. Imagine you're someone who lost their job in early 2009, a situation shared by millions, the experience of unemployment becoming common rather than exceptional. Perhaps you worked in construction, an industry that employed over 7 million at peak and is now shedding hundreds of thousands of jobs as building stops. Or finance, where even surviving firms are laying off thousands to cut costs, entire departments eliminated. Or retail, where consumer spending has collapsed and stores are closing. Or manufacturing, where orders have dried up and factories are running at half capacity. The specific industry barely matters, the recession is broad and deep, affecting nearly every sector except perhaps healthcare and government. Job losses cascading through economy as demand falls and businesses cut costs desperately. The experience of unemployment follows a pattern that becomes familiar to millions. The initial shock of notification, whether a formal meeting with HR or a mass announcement or simply not being called back for shifts. The disbelief that this is happening to you, the anger at circumstances, at the company, at the economy, at whoever can be blamed. Then pragmatic action, updating resume that hasn't been touched in years, applying to job postings online, networking with former colleagues and contacts, following leads that mostly go nowhere. The activity that provides sense of doing something even when outcomes are limited. Then the grinding patience as weeks turn into months, rejection letters arriving, or more often no responses at all, the silence eloquent in its message that hundreds of others are applying for the same positions. Savings depleting steadily despite cutting expenses, watching accounts decline, stress mounting as runway shortens, unemployment benefits helping but replacing only fraction of lost income, insufficient to maintain previous lifestyle, insufficient sometimes even for necessities. The morning routine changes fundamentally. No longer commuting to work, no longer having structure imposed externally by job requirements, instead checking job websites repeatedly, making calls that often aren't returned. The empty hours filled with searching that leads nowhere. The productive feeling of working replaced by frustration of trying to work without results. The days blur together, Monday indistinguishable from Friday when neither involves employment, the rhythm of weekends and work weeks dissolving, time marked by unemployment benefit certification days and the occasional interview rather than weekly schedule. The unemployment office becomes familiar location, a place visited weekly to certify continued eligibility, to prove you're still looking for work, to collect benefits that keep you marginally afloat. The office smells institutional, worn carpet cleaned too many times, processed air carrying hints of too many people in too small a space. The sounds are quiet conversations and phones ringing and keyboards clicking as staff process claims. The atmosphere is one of shared difficulty, everyone present due to circumstances largely beyond individual control, the judgment that attached to unemployment in better times largely absent, replaced by understanding that this is systemic, not individual failure. The staff are overworked, processing claims that number in millions rather than thousands, unable to provide much individual attention, the bureaucracy grinding slowly even as need is urgent, the system designed for normal times overwhelmed by crisis. The wait times are long, the forms are complex, the rules are arcane, the process designed more for preventing fraud than for helping people efficiently. But it's necessary, the benefits essential for survival while searching for new employment. The job interviews that do happen are discouraging experiences, dozens or hundreds of applicants for single positions, employers able to be extraordinarily choosy, wages offered lower than pre-crisis levels for same work, benefits reduced. You're competing against people laid off from companies that failed, experienced workers with excellent credentials willing to take less than their worth because options are limited. Some interviews feel humiliating, being asked to explain employment gap, defending yourself against implied accusation that unemployment reflects personal inadequacy. Knowing the truth is simply that jobs are scarce and applicants numerous. The financial strain affects everything in life. Small luxuries disappear first. The restaurant meals and entertainment and discretionary spending that made life pleasant but aren't strictly necessary. The cuts that seem manageable initially. But not strictly then necessary costs are examined critically, the cable television cancelled and replaced with free over-air broadcasts. The thermostat adjusted lower in winter and higher in summer to save utility costs. Generic groceries replacing brand names, family discussions about what else can be cut before truly difficult choices about housing or healthcare become necessary. The mortgage or rent remains non-negotiable, housing payments must be made, or homelessness results, but the cost is increasingly difficult as savings deplete and unemployment benefits prove insufficient. Credit cards are used to bridge gaps, balances rising month by month, minimum payments growing, the trap of debt tightening, future financial security being sacrificed for current survival. The calculus changes, the long-term considerations that guided decisions in stable times replaced by short-term necessity of getting through this month, next month, somehow keeping family housed and fed until employment returns. The neighbourhood reflects broader struggle, visible signs of economic distress appearing. Several houses now display foreclosure signs, families moved out, properties sitting empty awaiting bank decisions about disposition. Some homes show signs of neglect, lawns unmowed as unemployed owners can't afford landscaping services and lack energy for maintenance. Paint beginning to peel, minor repairs deferred indefinitely. The neighbourhood gatherings are less frequent, people staying home more to save money, the sense of community diminished both by shared difficulty and by embarrassment about discussing struggles, the social fabric fraying under economic pressure. The abandoned foreclosed homes develop their own character over months of vacancy. Windows remain dark, no curtains visible, mail accumulates in boxes. The interiors visible through windows show furniture sometimes left behind when families moved quickly, unable to afford movers or storage, abandoning possessions to escape mortgages they couldn't pay. The smell when passing these houses is of mustiness and staleness, of spaces without airflow, of decay beginning. The sound is silence, absence of the life that filled these spaces months or years ago, the quiet sometimes broken by vandals or squatters, problems that emerge when security disappears. Some homes are systematically stripped, copper piping pulled from walls and sold as scrap metal, appliances stolen. The projects funded are diverse. Highway construction creating jobs for laid-off construction workers while improving infrastructure. School renovations employing contractors while upgrading facilities. Weatherization programs improving energy efficiency while employing installers. Grants for renewable energy developing new industries while addressing climate concerns. The stimulus attempts to provide immediate boost while also investing in long-term productivity. The Keynesian theory that government spending can fill demand gap left by private sector retrenchment, the debate about effectiveness continuing even as implementation proceeds. The Federal Reserve, under Chairman Bernanke, engages in unprecedented monetary policy, interest rates cut to near zero by December 2008, federal funds target rate at 0 to 0.25%, as low as possible without going negative. But with rates at zero, conventional monetary policy reaches its limit, requiring unconventional measures never used in normal times. Quantitative easing, QE, involves Fed purchasing Treasury bonds and mortgage-backed securities, injecting money directly into financial system, expanding Fed's balance sheet from under $900 billion to over $2 trillion initially, eventually to $4.5 trillion through multiple rounds of QE. The mechanics are technical, but concepts straightforward. Fed creates bank reserves electronically, uses those reserves to buy bonds from financial institutions. The institutions receive cash they can lend to businesses and consumers, stimulating economic activity. The transmission mechanism proves imperfect, banks cautious about lending in recession, preferring to hold reserves rather than extend credit to risky borrowers. But the intent is to lower interest rates across yield curve, encourage borrowing and spending, boost asset prices, creating wealth effects that increase consumption. The monthly Federal Open Market Committee meetings become major events, statements passed word by word for clues about future policy, journalists and economists analysing each phrase change, markets reacting to hints about bond purchase pace and eventual exit strategy. The Fed attempts to guide market expectations while acknowledging genuine uncertainty about appropriate policy. The unprecedented nature of situation meaning historical precedents provide limited guidance, the effectiveness measurable only years later when recovery or lack thereof becomes evident. Time passes. You now find yourself in 2010 watching Congress write new financial regulations, Dodd-Frank Wall Street Reform and Consumer Protection Act, comprehensive overhaul of financial regulation attempting to address failures revealed by crisis. The legislative process is extraordinarily long, committees holding hundreds of hours of hearings, bank executives and regulators testifying, economists debating approaches, lobbyists working intensively to influence details, the bill growing to over 2,300 pages as compromises accumulate and special cases are addressed. The key provisions reshape financial landscape. Volcker Rule limits proprietary trading by banks, preventing them from speculating with own capital, though definition of proprietary versus market making proves complex to implement. Consumer Financial Protection Bureau created to regulate mortgages and other consumer financial products, preventing aggressive lending practices that contributed to crisis, though its authority is contested politically. Derivatives previously traded privately must now be cleared through central clearing houses, increasing transparency and reducing counterparty risk, though implementation proves technically challenging. Large banks subjected to annual stress tests demonstrating ability to survive severe economic scenarios, capital requirements increased substantially from pre-crisis levels. The implementation takes years, regulators writing hundreds of detailed rules to execute congressional intent. The process slower than critics want, but faster than banks prefer. Banks hire thousands of compliance officers, build systems to monitor Volcker, rule compliance, prepare living wills explaining how they could be resolved if failing, conduct internal stress tests, preparing for regulatory exams. The cost of compliance reaches billions annually for largest institutions, money spent on lawyers and consultants, and systems rather than lending. though whether this improves actual safety versus creating bureaucratic burden is debated endlessly. Whether Dodd-Frank prevents future crises or merely addresses last crisis while creating new vulnerabilities remains genuinely uncertain. The regulations increase capital, reduce leverage, improve transparency, but also create incentives for activities to migrate to less regulated shadow banking sectors, potentially creating new systemic risks. The unintended consequences won't be fully known for decades, effectiveness measurable primarily by crises that don't happen, the absence of evidence being inherently difficult to interpret or attribute to specific regulations. The recovery itself is painfully slow, the expansion beginning in June 2009, technically ending recession, but the recovery feeling worse than typical recessions to many participants. GDP grows but modestly, job creation insufficient to restore employment quickly, wages stagnant, even as corporate profits recover. Unemployment declines from 10% peak to 5% by 2015. But millions of workers never return to labour force, discouraged or disabled or retired early, the official rate understating difficulty. The housing market stabilises in 2012 and begins recovering, but many regions don't regain 2006 peak prices until 2016. Or later, decade of housing wealth lost, many homeowners still underwater years after crisis. You observe recovery as someone who maintained employment but saw colleagues laid off, your own wages frozen for years, promotions delayed, bonuses eliminated, 401k recovering gradually, but only after years of losses and volatility. The experience leaves you more cautious, more aware that security is conditional rather than guaranteed, that downturns happen to people who did nothing wrong, that prudence matters more than optimism. The psychological impact persists beyond economic statistics, entire generations scarred by what happened, approaching risk differently, saving more, borrowing less, the collective behaviour shaped by collective trauma. The patterns emerging from crisis reshape finance and economy. Home ownership rates decline from 69% to 63%, lowest in decades, millennials delaying home purchases or avoiding them entirely, renting becoming more socially acceptable and economically sensible. Mortgage lending standards tighten dramatically, the pendulum swinging from too loose to quite restrictive. Borrowers now needing strong credit scores and documented income, and substantial down payments, qualified mortgages defined narrowly excluding many marginal buyers. The banks that survived consolidate further, becoming even larger, too big to fail, becoming more true rather than less, concentration increasing despite concerns about systemic risk. Shadow banking grows in less regulated sectors, leveraged loans to corporations replacing some mortgage lending as source of yield, covenant-light loans with fewer protections becoming standard despite resembling subprime in structure, private credit funds replacing bank lending for middle market companies. The search for yield in low interest rate environment drives capital into riskier assets, the patterns that preceded crisis recurring in different forms, suggesting lessons learned may be specific to last crisis rather than general principles preventing next one. It is late now. You stand in office building that survived crisis, perhaps headquarters of major bank that absorbed failed competitors whose lights stayed on while others went dark. The office floor is quiet, most people having left, a few analysts working late on regulatory reports, stress test submissions, ensuring compliance with new rules. The desk shows scattered papers, spreadsheets with loss scenarios, models projecting capital adequacy under adverse conditions. the work of risk management that receives more resources and attention than before crisis. The Bloomberg terminal glows softly, markets closed but data still updating, overnight futures indicating tomorrow's direction. The city outside windows is lit, life continuing, commerce functioning, crisis, a memory though effects persist in regulations and behaviours and institutions. A risk manager reviews latest stress test results, scenarios where home prices fall 30% again, where unemployment rises to 10%, where GDP contracts sharply, testing whether bank has capital to survive. The models show passing grades, capital ratios above regulatory minimums, bank theoretically prepared for another crisis, though whether preparation is genuine or artifact of models remains uncertain. Whether Dodd-Frank prevents future crises or merely addresses last crisis while creating new vulnerabilities remains genuinely uncertain. The regulations increase capital requirements substantially, banks now holding twice as much capital relative to assets as before crisis, the cushion theoretically protecting against losses. Leverage is reduced. Investment banks that operated with leverage ratios of 30 to 1 before crisis now limited to much lower levels. The amplification of gains and losses constrained by regulations. Transparency is improved, derivatives traded on exchanges and cleared centrally, providing visibility that didn't exist when everything was private bilateral contracts. But the system is adaptive, creative, capable of finding new ways to take risk even within regulatory constraints. The shadow banking sector grows in less regulated areas, leveraged loans to corporations replacing some mortgage lending as source of yield for investors, the covenant-light loans with minimal protections for lenders resembling subprime mortgages in structure, if not in specific asset class. Private credit funds replace some bank lending, operating outside banking regulations, the activity migrating to sectors where oversight is lighter. The innovation continues, the financial engineering finding new expressions, the fundamental human drives toward risk-taking and profit-seeking not eliminated by regulations, however comprehensive. The unintended consequences of regulations emerge gradually over years of implementation. Volcker rule implementation proves extraordinarily complex, the distinction between market-making and proprietary trading being fuzzy in practice, banks spending millions on compliance systems to monitor and classify trades, examiners struggling to distinguish legitimate hedging from speculation. Some market participants argue liquidity has decreased in certain markets, dealers less willing to hold inventory, the rules intended to reduce risk, having side effect of making markets less efficient. The regulatory burden is substantial, particularly for smaller banks that lack resources of largest institutions. The compliance costs consuming capital that might otherwise support lending. The complexity favouring consolidation as smaller banks merge or sell to larger ones better equipped to handle regulatory requirements. The number of community banks declines steadily through recovery period, the landscape concentrating despite concerns about too big to fail. The regulations designed to make systems safer, potentially making it more concentrated and therefore more systemically risky. The recovery itself is painfully slow, frustratingly gradual for millions experiencing it. The expansion beginning in June 2009, technically ending recession, but the recovery feeling worse than typical recessions to many participants, because the damage was deeper and healing is slower. GDP grows but modestly, averaging around 2% annually through most of recovery, far below the robust 4 to 5% growth that typically follows deep recessions, the sluggish pace reflecting damaged household balance sheets, tight credit conditions, global headwinds from European debt crisis, policy uncertainty, structural changes in economy. Job creation is insufficient to restore employment quickly, the unemployment rate declining from 10% peak very slowly, taking years to return to pre-crisis levels. Millions of workers experiencing long-term unemployment that damages careers and skills. The gap in work history creating permanent scars. The labour force participation rate declines, millions of workers leaving workforce entirely, some retiring early, others becoming discouraged, others claiming disability. The headline, Unemployment Rate Understating True Difficulty, as it only counts active job seekers. The quality of jobs created during recovery is concerning. Many positions are part-time or temporary. Wages are stagnant, even as corporate profits recover strongly, the benefits of growth accruing disproportionately to capital owners and highly skilled workers, while median household income remains flat or declines. The pattern of recovery differs from historical experience, where labour and capital recovered together, this time featuring corporate profit growth without corresponding wage growth, creating divergence between Wall Street prosperity and Main Street struggle. The housing market stabilises gradually, home prices bottoming in 2012 in most markets, then beginning slow recovery that takes years to regain pre-crisis peaks in many regions. Some markets like San Francisco and New York recover quickly, reaching new highs by 2015, but others like Las Vegas and Phoenix and inland California take until 2020 or later to regain 2006 peak prices, a decade and a half of lost housing wealth. Many homeowners remaining underwater on mortgages years after crisis, unable to move even if jobs are available elsewhere, because selling would require bringing cash to closing to cover the difference between sale price and mortgage balance. The foreclosure crisis leaves lasting scars, millions of families displaced, credit histories damaged, the trauma of losing home affecting families for years. The children who experience foreclosure during childhood show measurable effects on educational outcomes and behaviour. The instability of moving multiple times, changing schools, the stress of parents, affecting development in ways that persist into adulthood. The neighbourhoods most affected by foreclosures show slower recovery, property values depressed longer, social capital destroyed as communities dispersed, the rebuilding of neighbourhood stability taking years or decades. The generation that came of age during crisis is permanently affected, millennials entering adulthood during Great Recession facing damaged job markets, carrying heavy student debt loads, delaying traditional milestones of adulthood like marriage and home ownership, and starting families. The home ownership rate for young adults declines substantially, the shift from ownership to renting becoming structural rather than temporary. The attitudes toward housing and debt fundamentally different from previous generations who experience only rising prices and easy credit. The patterns that emerge from crisis reshape finance and economy in lasting ways. Home ownership rates decline from 69% peak to 63%, not recovering fully even a decade later. The American dream of universal home ownership revealed as unsustainable, renting becoming more socially acceptable and economically rational, particularly in expensive coastal cities where home prices remain out of reach for middle-class buyers. The percentage of young adults living with parents increases substantially. The economic independence that was typical for 20-somethings in previous generations delayed or deferred. The multi-generational households that were common in earlier eras returning as adaptation to economic constraints. Mortgage lending standards tighten dramatically and remain tight, the pendulum swinging from too loose to quite restrictive and not swinging back. borrowers now needing strong credit scores above 700, documented income with pay stubs and tax returns, substantial down payments of 20% for best rates, the qualified mortgage rules defining narrow parameters that exclude many marginal buyers, the automated underwriting that said yes in 2005 now says no in 2015 to borrowers who would have qualified easily before crisis, the risk aversion embedded in regulations and institutional memory preventing return to easy credit even after economy recovers. The financial sector consolidates further, the banks that survived the crisis absorbing failed competitors, growing larger despite too big to fail concerns. JP Morgan acquires Bear Stearns and Washington Mutual, becoming enormous. Bank of America acquires Merrill Lynch and Countrywide, though the Countrywide purchase proves costly. Wells Fargo acquires Wachovia. The top banks become even more dominant, controlling larger share of assets and deposits, the concentration increasing rather than decreasing. The goal of reducing systemic importance not achieved, some institutions now arguably more systemic than before crisis. The shadow banking sector grows in less regulated spaces, the leveraged loan market exploding, covenant-light loans with minimal protections becoming standard despite resembling subprime in structure, the same pattern of loosening standards emerging in different markets. Private credit funds raise hundreds of billions, lending to middle market companies outside traditional banking system, the activity migrating to areas with lighter regulation. The search for yield in low interest rate environment drives capital into riskier assets, the patterns that preceded crisis recurring in different forms, though different sectors. The private equity firms buy thousands of foreclosed homes, converting them to rentals, creating large institutional landlords owning tens of thousands of properties, changing the housing market structure, the homes that were once owner-occupied. Now rental properties controlled by Wall Street firms, the financialization of housing continuing through different channels. The firms argue they provide liquidity and professional management. Critics argue they extract wealth from communities while reducing home ownership opportunities, the debate reflecting larger questions about financialization of real assets. Technology changes how finance operates, the crisis accelerating trends toward digitization and automation. Fintech companies offer mortgages online, Quicken Loans and others originating billions without physical branches. The application and approval process becoming digital, algorithmic underwriting replacing human judgment. The efficiency improving, but concerns emerging about algorithmic bias, whether credit models trained on historical data perpetuate discrimination, whether digital divide excludes those without internet access or technological literacy. The mobile banking apps enable banking without branches, millennials comfortable managing finances entirely through phones, never visiting physical bank, the branch networks that were competitive advantages becoming liabilities, the real estate and staff required for physical presence being expensive overhead. The traditional banks close thousands of branches, shifting to digital channels. The neighborhood bank that was community institution becoming app on smartphone. The relationship banking replaced by algorithmic interactions. The lessons of crisis are studied extensively by academics and policymakers, thousands of papers and books analysing what went wrong, what could have been prevented, what policies should change to reduce probability of future crises. The consensus lessons that emerge from research include several key points about housing, finance, regulation, but also substantial disagreement about implications and appropriate responses, the complexity of crisis resisting simple narratives or universal agreement. The lessons about housing focus on recognizing that prices can fall nationwide, that real estate is not always safe investment, that leverage amplifies gains but also losses, that assumptions about perpetual appreciation are dangerous. The policies responding to these lessons include tighter mortgage standards, higher down payments, better income documentation, but also unintended consequence of reduced access to credit for marginal borrowers. The trade-off between stability and inclusion proving difficult to optimize. The lessons about finance emphasize that diversification fails when correlations increase during crises, that ratings can be catastrophically wrong when based on flawed models and misaligned incentives, that financial innovation can create systemic risk when not properly understood or regulated, that leverage needs limits to prevent amplification of losses, that liquidity can disappear, suddenly requiring backstops. The Dodd-Frank regulations attempt to address these lessons through capital requirements, stress tests, resolution authority, central clearing of derivatives, but implementation is complex and effects uncertain. The lessons about regulation highlight that light touch approach, allowing innovation and self-regulation proved inadequate, that regulatory gaps allowed risks to accumulate in shadow banking, that international coordination is necessary given global interconnection of finance, that regulations need to be counter-cyclical tightening during booms rather than only responding after busts. But implementing these lessons requires political will that often fades as crisis memory recedes, the regulations imposed during crisis being loosened during boom as industry lobbies for relief and public forgets pain of last crisis. The institutional memory of crisis fades surprisingly quickly. The regulations remain, but understanding of why they exist diminishes. The new employees hired after crisis not having experienced it directly, the collective knowledge dependent on documentation rather than lived experience. The banks hire employees who don't remember crisis, train them on regulations without necessarily conveying underlying reasons. The compliance becoming checklist exercise rather than genuine risk management. The bureaucratic forms being filled out without deep understanding of risks being managed. It is late now, approaching midnight. You stand in an office building that survived the crisis, perhaps the headquarters of a major bank that absorbed failed competitors whose lights stayed on while others went dark, whose employees remained employed while thousands of competitors were laid off. The building is mostly dark now, most floors empty, people having left for evening except for a few working late. The cleaning crews vacuuming and emptying trash, the security guard making rounds, the structure operating on night mode. The office floor where you stand is quiet, just a few lights still on where analysts work late on regulatory reports, stress test submissions due next month, quarterly capital reports being finalised, the work of compliance and risk management that receives more resources and attention than before crisis. The departments that were afterthoughts in boom, now essential functions employing hundreds. The desk you observe shows scattered papers, spreadsheets showing loss scenarios, models projecting capital adequacy under adverse conditions where unemployment rises and home prices fall and economy contracts, the stress tests designed to ensure bank can survive another crisis without government support. The Bloomberg terminal glows softly, its multiple screens showing markets now closed but data still updating, overnight futures indicating tomorrow's likely opening direction. Asian markets already open and trading, the 24-hour cycle of global finance continuing regardless of New York business hours. The screens show indices, prices, news feeds, charts, the information density that traders absorb continuously during market hours, now reduced to ambient monitoring, the urgent activity of daytime replaced by quiet maintenance of awareness. The city outside the windows is lit but quieter than daytime, the financial district emptying after markets close, the restaurants and bars that serve lunch crowds closing early in absence of business. The streets where traders once celebrated bonuses now mostly empty except for occasional late workers heading home. The lights of buildings extend into distance, Manhattan skyline recognizable from thousands of photos and movies, the symbolic capital of American finance continuing to function, though changed by crisis, chastened but not destroyed, adapted but recognizable. A risk manager sits at a desk reviewing the latest stress test results, checking scenarios where home prices fall 30% again, where unemployment rises to 10%, where GDP contracts sharply, where liquidity stress tests banks' ability to survive runs. The models show passing grades, capital ratios above regulatory minimums, even in adverse scenarios. The bank theoretically prepared for another crisis, though whether this preparation is genuine or artifact of models calibrated on last crisis remains uncertain. The next crisis likely coming from different direction than last one. The regulatory reports are filed regularly now, quarterly capital reports showing Tier 1 ratios and supplementary leverage ratios and liquidity coverage ratios, annual stress tests demonstrating capital adequacy under standardized adverse scenarios, resolution plans or living wills, explaining how bank could be resolved if failing without government support, the paperwork of compliance substantial, measured in thousands of pages annually. The cost of producing these reports reaches hundreds of millions for largest banks, armies of employees dedicated to compliance, consultants and lawyers reviewing, systems built to capture data, the infrastructure of regulation becoming industry unto itself. The listener is drifting now, the story fading gently into background of consciousness, the detailed account of crisis blending into general impression, the specifics of CDOs and TARP, and Dodd-Frank becoming less distinct, the overall arc from optimism to crisis to recovery, becoming the narrative that remains, the lessons about risks and regulations and human nature settling into subconscious. The crisis that began with families buying homes and ended with unemployment and foreclosures, that affected millions but was survived, that changed finance and regulation without fundamentally altering human nature or market cycles, becomes a quiet memory, lessons learned that will eventually fade as new generations enter markets. New innovations create new risks, new optimism replaces hard-won caution. From those teaser rate mortgages in 2004 to the trillion-dollar bailouts of 2008, from rising home prices creating wealth effects to foreclosure signs destroying neighborhoods, from AAA ratings blessing securities that would fail to actual losses exceeding models' worst cases. The crisis unfolded with the inexorable logic of accumulated risks eventually mattering, of optimism meeting reality, of systems built on assumptions that proved wrong. The experience was painful but survived, adaptation occurred, the system continued, life moved forward, as it does, as it must, the alternatives being unthinkable. Markets open tomorrow morning, traders will arrive in early hours, screens will light up with pre-market activity, news will be absorbed and interpreted, positions will be taken, risks will be managed or mismanaged, the daily rhythm of finance continuing, more carefully now perhaps, more aware of what can go wrong, but continuing nonetheless because that's what markets do, what capitalism does, what human economic activity does. Absorbing shocks, adapting, adjusting, moving forward into uncertain futures that will bring new challenges, new crises, new responses, the cycle continuing. Somewhere tonight, someone is checking home prices online, seeing their home's value planning their financial future around assumptions that seem reasonable today but may prove wrong tomorrow, believing that lessons have been learned, that it's different this time, that the problems of past won't recur, the same optimism that preceded last crisis, germinating seeds of next one. The dream persists, chastened but not dead, adapted but not abandoned, the American dream of home ownership and prosperity continuing despite what happened. Because hope springs eternal and memory fades, and new generations believe they'll be different, smarter, luckier than those who came before, the pattern repeating, as it always has through history, boom and bust, crisis and recovery, optimism and despair, the pendulum swinging through its arc. Rest now, knowing that cycles repeat, that recovery follows recession, that dawn follows night, though darkness may linger, and light returns gradually rather than suddenly. Rest knowing that tomorrow markets open again, the rhythm continues, persistent, inevitable, human, the great machine of commerce and finance and human economic activity moving forward regardless of individual understanding or control, carrying us all along whether we comprehend it fully or not, the story continuing beyond this telling, beyond this moment, into futures we cannot see but will discover together, one day at a time, one decision at a time, the human story of striving and failing and adapting and continuing, the eternal story that has no ending, only chapters. This crisis, one chapter now closed, next chapter yet to be written but surely coming, as certain as tomorrow's sunrise, as inevitable as human nature itself.